Before we begin, please remember that the information in this presentation is for educational and informational purposes only. It is not, and should not be considered financial, legal, or investment advice. I am not a financial advisor. The world of investing is complex and involves significant risk, including the potential loss of principal. Always conduct your own thorough research and consult with a licensed financial professional before making any investment decisions. In 1997, if you had put just $1,000 into a little-known online bookstore's IPO, your investment today would be worth over $2 million. That company was Amazon. $2 million. From a single grand. Now let's be honest. How many times have you heard that term, IPO, on the news? You see the headlines, massive tech IPO on Wall Street, or unicorn company files to go public. You see the founders ringing the bell on the New York Stock Exchange, confetti flying everywhere, and you nod along, while a little voice in your head is screaming, What does that actually mean? You feel like you're on the outside of a conversation that is shaping the entire world, a conversation about how massive wealth is created in America. That's you are not alone. And that feeling ends today, because the single greatest wealth creation event in the modern economy is something most people don't truly understand. And by the end of this video you will. We are going to demystify the initial public offering. We're going to strip away all the confusing jargon and complicated financial speak and break it down into simple, plain English. This isn't just for Wall Street traders or Silicon Valley insiders. This is for you. This is a beginner's guide to understanding the engine of American capitalism. We're going to go from what does IPO even stand for, all the way to understanding the entire high-stakes process, the powerful players involved, the immense risks, the legendary rewards, and exactly how a private company you love, maybe a local restaurant chain or a cool new software startup, transforms almost overnight into a publicly traded giant on the world stage. So let's start at the very beginning. What is an IPO? The letters stand for initial, public, offering. An initial public offering is the very first time a privately owned company offers shares of its stock to the general public. It's the moment a company transitions from being private to being public. Okay, that's the textbook definition. It's accurate, but it's also boring. And it doesn't really tell you the story. So let's use an analogy. Imagine a company is a house. A big, beautiful, privately owned house. When the company is first starting out, this house is owned entirely by its founder. Let's call her Jane. Jane built this house from the ground up. She owns every brick, every window, every single nail. It's her private property. She can paint the walls whatever color she wants. She can have loud parties. She can make all the decisions without asking anyone for permission. As her business grows, she needs some money to build a new wing onto the house. So, she goes to her wealthy friends and family, and maybe a few professional investors called venture capitalists. She says, hey, I need some cash to expand. In exchange, I'll give you a piece of my house. You can own the master bedroom, you can own the kitchen. These early investors are now part owners. But it's still a private arrangement. There are maybe 5, 10, 50 owners in total. They all know each other. They have private meetings around the dinner table to decide the future of the house. The general public, you and me, we can't buy a piece of this house even if we wanted to. There's a big private property and no trespassing sign out front. This is a private company. Think of companies like SpaceX, the grocery chain Publix, or Mars, the company that makes M&Ms. These are massive, successful companies, but they are private houses. You can't just go online and buy a share of them. But then something changes. Jane's house becomes incredibly successful. People are lining up down the block just to look at it. She has huge ambitions. She doesn't just want to add a new wing anymore. She wants to build a skyscraper on the property. She wants to buy the 10 houses next door and build an entire community. To do that, she needs a staggering amount of money. Far more than her small circle of private investors can provide. At the same time, some of her early investors, the ones who bought the kitchen 10 years ago, are thinking, wow, my piece of this house is worth a fortune now. I'd love to sell it and buy a yacht. But they can't. Who do they sell it to? They can only sell to another private, wealthy investor, which can be hard to find. There's no easy, open market for it. This is the critical moment. Jane and her investors decide to do an IPO. They decide to take their private house and make it public. They are going to take the entire house, hypothetically divided into say 10 million identical bricks, and sell a portion of those bricks, let's say 2 million of them, to absolutely anyone who wants to buy one. This is the initial public offering. It's the grand opening. The private property sign is torn down and replaced with a giant, "Welcome, everyone" banner. Suddenly you meet your cousin in Ohio, a hedge fund in New York, a pension fund in California. Anyone can now own a tiny piece of Jane's house by buying one of these bricks. These bricks, in the real world, are called shares of stock. By buying a share, you become a part owner, a shareholder. You may only own one brick out of 10 million, but you are an owner nonetheless. The day of the IPO is a massive fundraising event. The company isn't just getting a loan. It's selling off pieces of itself for permanent capital. That money from selling the 2 million bricks goes directly into the company's bank account. Boom! Jane now has the hundreds of millions or even billions of dollars she needs to build her skyscraper and execute her grand vision. And those early investors, they can now easily sell their remaining bricks on the open market, like the New York Stock Exchange, anytime they want, finally cashing in on their long-term bet. But this transformation comes at a huge cost. The house is no longer Jane's private sanctuary. It's now a public building. She can't just decide to paint the walls purple on a whim. She now has thousands, maybe millions of co-owners, the shareholders. She has to answer to them. She is legally required to open up her books and report, every 3 months, exactly how much money the house is making, how much it's spending, and what her plans are for the future. This is called a quarterly earnings report. Everything is now public, transparent, and heavily regulated by the government, specifically a group called the SEC, the Securities and Exchange Commission. They are like the city's toughest building inspectors, making sure everything is up to code and that the public owners aren't being misled. So let's connect this back. The private house is the private company. The founder and early investors are the private owners. The need for massive expansion capital is the primary motivation for an IPO. The IPO itself is the process of selling bricks, or shares of stock, to the general public for the first time. The stock market, like the Nasdaq or the New York Stock Exchange, is the public marketplace where these shares can be bought and sold every day after the IPO. And the founder, who is now the CEO of a public company, has gone from being a private owner to a public steward, responsible to every single person who bought a share. This is the fundamental trade-off. A company gives up its privacy and a measure of control in exchange for two things: a massive injection of cash to fuel growth, and a way for early investors and employees to finally turn their paper wealth into real money. It's the biggest moment in a company's life. It's its debutante ball, its graduation, and its first day on the job, all rolled into one massive, high-stakes public event. But how does a company actually prepare for this? It's not as simple as just putting up a for sale sign. It's a grueling, expensive, and incredibly complex process that can take over a year to complete. It involves hiring Wall Street's most powerful gatekeepers, the investment banks, who will literally take the company on a worldwide tour to sell its story. What is that tour called? And what really happens behind the closed doors of an investment bank as they decide the single most important number in the entire process? The IPO price. We're going to pull back the curtain on all of it. That tour is called the Roadshow, and it is every bit as intense as a multi-city concert tour for a rock band. Forget tour buses and screaming fans, though. This is a world of private jets, 5-star hotels, and hushed conference rooms in New York, Boston, London, and Hong Kong. For 2 straight weeks, the company's CEO, CFO, and their entourage of investment bankers from Goldman Sachs or Morgan Stanley live out of suitcases. Their mission? To perform. They deliver the same polished presentation, sometimes 5 or 6 times a day, to the most powerful money managers on the planet. Their audience isn't you or me. It's the gatekeepers of capital. These are the institutional investors. Massive pension funds managing the retirement savings of millions of teachers and firefighters, mutual funds that you might own in your 401k, and secretive hedge funds that can move markets with a single trade. Why them? Because they have the firepower. They aren't buying 100 shares. They're indicating interest in buying 1 million, 5 million, 10 million shares. Getting these giants on board is critical. They are the bedrock of a successful IPO. If they believe in the story, the IPO has a strong foundation. If they walk away, the whole deal can collapse. The CEO is the lead singer, the visionary. They sell the dream. They paint the picture of how their company is going to change the world, disrupt an industry, and generate massive returns. The CFO is the lead guitarist, the technical virtuoso. They have to back up the dream with cold, hard numbers. They walk through the financials, the growth metrics, the profit margins, answering grueling, specific questions about cash flow and customer acquisition costs. And the investment bankers? They're the tour managers, the producers, the hype men. They work the room, gauge the mood, and translate the vague interest of a fund manager into a concrete number. But this isn't just a verbal pitch. The entire roadshow is based on one of the most important documents in business, the S-1 registration statement. Before any of this can happen, the company has to file this massive document with the U.S. Securities and Exchange Commission, or SEC. The S-1 is the company's official, legally binding autobiography, and it is brutally honest. Think of it like this. The roadshow presentation is the glossy, airbrush dating profile picture. The S-1 is the full background check, complete with every awkward high school photo, every failed relationship, and every single financial mistake. It contains everything. Decades of financial history, the exact salary of every top executive, and most importantly, a section called Risk Factors. This is where the company is legally required to disclose every single thing that could possibly go wrong. Competition could crush us. Our key technology could become obsolete. We might never be profitable. We rely on one single supplier who could go out of business tomorrow. Reading the risk factors section of an S-1 is like reading the side effects on a new medication. It's designed to scare you, but it's essential information. The SEC pores over this document, sending back questions and demanding clarifications. Only when the SEC gives its blessing can the roadshow officially begin. So, as the CEO and CFO are flying from city to city, the bankers are doing something critically important in the background. They are building the book. This is the real, hidden purpose of the roadshow. It's not just a performance, it's an intelligence-gathering operation. After each meeting, the bankers on the team are on the phone, huddling in corners. They're asking the big fund managers, "So what did you think? Are you in? And if so, how many shares would you be willing to buy at, say, $20? What about 22? They are essentially conducting a massive, high-stakes auction before the auction even starts. They're creating a secret ledger, the book, that shows the entire demand for the company's stock at various price points. This book is the Holy Grail. It tells them if the IPO is oversubscribed, meaning way more people want to buy shares than are available, a very good sign. Or it tells them if demand is weak, which could be a disaster. The fate of the entire IPO lives inside this constantly updating, confidential spreadsheet. Now we get to the most crucial decision, setting the price. All of this, the S-1 filing, the grueling roadshow, the book building, it all leads to a single number, the official IPO price. The price at which the company will sell its shares to those first institutional investors. How is this number decided? It is a fascinating mix of art and science. First, the science. The bankers look at comps, or comparable public companies. If you're a new electric vehicle company, they'll analyze the stock valuations of Tesla, Rivian, and Lucid. They'll look at metrics like the price-to-sales ratio or price-to-earnings ratio to establish a ballpark range. They'll run complex financial models, called discounted cash flow analyses, to project the company's future earnings and assign a present-day value. But then the art comes in. This is where the gut feeling and experience of a seasoned banker is worth millions. They have to read the market's mood. Is the stock market booming? Or is it fearful? Is there a lot of hype for tech IPOs right now? Or are investors cautious? And most importantly, what is the book telling them? If the book is 10 times oversubscribed at $20 a share, they know they have immense demand and can probably price it higher. This leads to a fundamental, hidden conflict of interest in every IPO. The company naturally wants the highest price possible. If they sell 10 million shares, the difference between pricing at $20 and $22 is an extra $20 million in their bank account. Money they can use to hire engineers, build factories, and grow the business. But the investment bank and the institutional investors they cater to want something else. They want an IPO pop. You've heard of this. It's when a stock is priced at, say, $20 a share, and on the first day of trading it immediately jumps or pops to $25 or $30. For the institutional investors who got to buy at $20, that's an instant 25 to 50% profit. It makes them very happy and ensures they'll be eager to participate in the next IPO the bank underwrites. For the bank, a successful pop creates buzz, gets positive headlines in the Wall Street Journal, and cements their reputation as a kingmaker. So the bankers have to walk a tightrope. Price it too high and the stock might fall on the first day. This is a broken IPO. A catastrophic failure that embarrasses everyone involved. Price it too low, and they leave millions of the company's dollars on the table. A decision that will get them screamed at by the company's board of directors. The final pricing meeting often happens the night before the stock is set to begin trading. Imagine a glass-walled conference room on the 40th floor of a Manhattan skyscraper. The company's founders, CEO, and board members are on one side of the table, exhausted from the roadshow. The lead bankers are on the other. They present the final book. They present their recommendation. They argue. They debate. And finally, they agree on a number. Let's say $21 per share. That is the number. The IPO price is set. The giant machine is locked and loaded. Billions of dollars are about to change hands. But who actually gets to buy at that special initial price of $21? Is there any way for a regular person sitting at home to get in on that deal before the stock pops? And what exactly happens at 9:30 a.m. the next morning when that opening bell rings on the New York Stock Exchange, and the company's stock is unleashed to the entire world for the very first time? Well, to understand what happens at 9:30 a.m., we first have to rewind a few weeks to a grueling caffeine-fueled cross-country marathon known as the Roadshow. This is where the magic and the money really starts to happen. Forget the public for a moment. Before a company can sell its stock to you, it has to sell its story to the biggest players on Wall Street. The CEO, the CFO, and a team of their top investment bankers board a private jet. Their mission? A whirlwind tour of cities like New York, Boston, Chicago, and San Francisco. For 2 solid weeks, they live out of suitcases, giving the same high-stakes presentation sometimes 8 times a day. They're not meeting in coffee shops. They're in the glass-walled boardrooms of massive institutional investors. We're talking about the mutual funds that manage your 401k, the pension funds for firefighters and teachers, the hedge funds with billions of dollars under management. These are the titans of the financial world. The whales who can make or break an IPO with a single decision. The pitch is polished to perfection. They talk about their vision, their groundbreaking technology, their massive market opportunity, and of course they show the hockey stick growth chart that every investor loves to see. After the presentation, it's a grilling. The fund managers, these stone-faced analysts who have seen thousands of these pitches, poke and prod at every single number. They ask the tough questions. What about your competition? How sustainable are your profit margins? What happens if a recession hits? The company's executives have to have an answer for everything. Their goal is to convince these giants that their company isn't just a good investment, it's the next big thing. But this isn't just a sales pitch. It's also a fact-finding mission for the investment bank. As they meet with these funds, the bankers are quietly taking notes, engaging in a process called book building. It's one of the most crucial and least understood parts of an IPO. Essentially, they're conducting a private preliminary auction. They'll ask a fund manager, "So what do you think? If we price the shares at, say, $20, how many would you be interested in buying?" The fund manager might say, "At 20, we'd be in for 5 million shares. But if you price it at 18, put us down for 10 million. The bankers do this over and over, with dozens of institutions, collecting these non-binding indications of interest. They're building a ledger, a book of demand, showing them exactly who wants to buy, how many shares they want, and at what price. This gives them a crystal-clear picture of the market's appetite for this new stock. Is it lukewarm? Or is it a feeding frenzy? While all this high-flying salesmanship is happening, something else, something much more public and legally binding, is taking place. The company has filed a massive document with the U.S. Securities and Exchange Commission, the SEC. This document is called the S-1 registration statement. And if the roadshow is the glossy movie trailer, the S-1 is the unedited, behind-the-scenes documentary, complete with all the ugly parts. By law, a company going public has to disclose everything. The S-1 is basically the company's soul, laid bare for the world to see. It's a treasure trove of information, often hundreds of pages long, written in dense legalese. But if you know what you're looking for, it's the single most valuable resource for understanding a company. In the S-1, the company must list in excruciating detail every conceivable risk factor. This is the section where they have to imagine all the ways their business could fail. They have to admit that they face intense competition, that they might not be profitable, that they depend on a few key employees, that their technology could become obsolete. It's the most brutally honest and pessimistic part of the entire process. The S-1 also contains years of audited financial statements. Revenue, profits, losses, debt. It's all there. It details exactly who owns the company before the IPO, how much the CEO gets paid, and any shady dealings with related parties. For any serious investor, reading the S-1 isn't optional. It's essential homework. It's the company's confession, And it's all available for free on the SEC's website for anyone to read. Okay, so let's fast forward. The 2-week roadshow is over. The executives are exhausted. The bankers have filled their book with billions of dollars in potential orders. Now comes the moment of truth. It's the night before the IPO. The CEO, the lead bankers, and lawyers all gather in a conference room. The air is thick with tension. It's time for the pricing meeting. The bankers lay out the book. They'll say something like, okay, the initial price range we discussed was $18 to $20, but the demand is off the charts. We have orders for 20 times the number of shares we're planning to sell. The book is strong all the way up to $23. Now a debate begins. The company wants the highest price possible. A higher price means they raise more money to grow the business. But the investment bank has a different incentive. They want to price it just a little bit below the overwhelming demand. Why? They want to ensure a successful first day of trading. They want the stock to pop. If they price the shares at $20, and the stock immediately jumps to $25 when it starts trading, everyone is happy. The institutions who bought at 20 see an instant 25% gain, making them feel like valued clients. This goodwill is crucial for the bank's future business. The company gets positive headlines about its successful IPO, and the bank looks like a hero for orchestrating the whole thing. It's a delicate, high-stakes balancing act. Price it too high and the stock could fall on the first day. A disastrous outcome that labels the IPO a broken deal. Price it too low, and the company leaves millions of dollars on the table. After hours of discussion, they finally agree. They settle on a final IPO price. Let's say it's $21 per share. This is the official institutional price. The price you read about in the news. The deal is priced. Now, the final step before the opening bell allocation. The bankers go back to that book of demand and decide who gets what. That giant mutual fund that committed early? They get their full 10 million shares. That hedge fund that was wishy-washy? Maybe they only get half of what they asked for. It's a frantic game of rewarding the bank's best clients and ensuring the shares are in the hands of long-term holders, not flippers, who will sell immediately. And what about you, the regular investor sitting at home? Can you get shares at this exclusive $21 price? For the vast majority of people, the answer is a resounding no. This part of the deal, the allocation at the IPO price, is almost exclusively for the big institutions and a few ultra-high net worth clients of the investment bank. It's the VIP room of the financial world. So the sun sets. The price is locked in at $21. The shares have been allocated to the chosen few. The company has officially sold its shares, and the money is wired to its bank account. Everything is set. And as the sun rises over New York City, a handful of company executives, now incredibly wealthy on paper, make their way to the floor of the New York Stock Exchange. They are about to ring the opening bell. A symbolic act that will transform their private dream into a public reality. But what actually happens in those first few chaotic minutes of trading? Who is buying and who is selling? And why does that $21 price almost immediately become a historical footnote? What is the pop? And is it really the sign of success everyone thinks it is? To understand this frenzy, you have to picture two distinct groups of people, separated by a velvet rope. On one side, inside the exclusive club, are the institutions. The hedge funds, the mutual funds, the big banks. They are the ones who got the call from the underwriter. They are the ones holding millions of shares they bought for that tidy pre-negotiated price of $21. On the other side of the rope, clamoring to get in, is, well, everyone else. It's retail investors like you and me, sitting at home with our E-Trade or Robinhood accounts open. It's other institutions who didn't get as many shares as they wanted, or weren't invited to the party at all. For weeks, maybe months, the media has been hyping this company up. The roadshow created a narrative of unstoppable growth. Everyone wants a piece of the next big thing. The demand is enormous, a tidal wave of buy orders waiting to crash onto the shore. The supply? It's fixed. It's only the shares the company decided to sell in the IPO. So the bell rings. The market opens. The velvet rope drops. What happens? A feeding frenzy. The first sellers are often those very same institutions. Not all of them, of course. Many are in it for the long haul. But a significant portion are what's known in the industry as flippers. Their entire strategy is to get that initial discounted IPO allocation and immediately sell it into the public market for a quick, massive profit. Think about it. If you could buy something for $21, knowing there's a line of people around the block willing to pay $35 for it a minute later, would you sell? For these flippers, it's one of the best deals in finance. They took on some risk by agreeing to buy the shares, and this is their reward. The buyers are that massive crowd that was waiting outside. Their collective demand, all hitting the market at once, overwhelms the initial supply of shares being offered for sale. Basic economics takes over. When demand vastly outstrips supply, the price doesn't just rise, it skyrockets. The first trade might happen at $32, the next at $34. Within minutes, it's trading at $35.50. This initial, often dramatic surge in price from the IPO offer price to the price on the open market is what everyone calls the IPO pop. If our hypothetical company priced its IPO at $21 and open trading at $35, that's a $14 jump. In percentage terms, that's a 66% pop. The headlines will scream, Company X soars 66% in blockbuster IPO debut. The CEO will be on television smiling. The bankers will be high-fiving. On the surface, it looks like a tremendous, unqualified success. But here's the secret that most beginners don't understand. The IPO pop is a paradox. It's both a sign of success and a sign of a massive failure. Let's look at it from the perspective of the institutions who got the $21 shares. For them, it's an incredible win. They made a 66% return on their money in a matter of hours, sometimes minutes. They are thrilled with the underwriter who gave them that opportunity. They will definitely answer that underwriter's call for the next hot IPO. For the public, for the media, it creates a powerful story. It validates the hype. It makes the company look desirable and successful, generating a ton of free publicity. It makes all the new investors who bought shares on the open market feel smart, because the price is going up. But now, let's look at it from the company's perspective. The actual company that just went public. They sold, let's say, 50 million shares to raise money. They sold them for $21 each. That means they raised $1,050 million. That's a huge amount of money, destined to fund new factories, hire engineers, and fuel expansion. But wait, a few minutes after the IPO, those exact same shares are worth $35 each on the open market. What does that mean? It means there were people willing to pay $35 for those shares. But the company only got $21 for them. The difference, that $14 pop, didn't go to the company. It went directly into the pockets of the underwriter's institutional clients who flipped their shares. Let's do the math. $14 per share times 50 million shares. That equals $700 million. $700 million. That is money the company left on the table. It's money that could have built 3 new research facilities. It's money that could have doubled their marketing budget for the next 5 years. It's money that could have been used to acquire a competitor. Instead, it became an instant, nearly risk-free profit for a handful of Wall Street's biggest players. So while the CEO is smiling for the cameras, you have to wonder what the chief financial officer and the board of directors are thinking behind closed doors. They just massively underpriced their own company and, in doing so, handed over $700 million of their potential value to Wall Street. This is the underwriter's tightrope walk. Their job is to get the pricing just right. If they price the IPO too high, say at $30, and there isn't enough public demand, the stock could open flat or even fall. This is called a broken IPO. It's a disaster. It signals to the market that the company is overvalued. It embarrasses the underwriters, and it makes everyone who bought shares instantly lose money. No one wants this. To avoid a broken IPO, underwriters have a massive incentive to be conservative. To price the shares low enough to guarantee there will be a frenzy of buying, ensuring the price will go up. This creates the pop. A healthy pop, maybe 10 to 15%, is often seen as the sweet spot. It shows strong demand without looking like a total giveaway. But when you see these massive pops of 50, 100, or even 200% like we saw with companies like Snowflake or DoorDash, it's a clear sign that the company was fundamentally mispriced. The bankers, in their quest to create a successful media event and reward their best clients, cost the company that went public a fortune. It raises a fundamental question. Who are the investment bankers really working for? The company that's paying them millions in fees to manage their IPO? Or their network of institutional buyers who they rely on to make every deal a success? The IPO pop suggests the answer is a lot more complicated than you'd think. So this first day of trading is a whirlwind of conflicting interests. The company wants its money. The early investors want validation.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The underwriters want a smooth deal and happy clients, and the public wants a piece of the action. But there's another group we haven't talked about yet, a crucial group, sitting on the sidelines, watching this all unfold with a mix of excitement and anxiety. They are the company's own employees. The engineers, the marketers, the early executives who have toiled for years, paid in a mix of modest salary and a promise of valuable stock options. For them, this IPO is the culmination of a life's work. This is their payday. So, with the stock now trading at $35, can they finally sell their shares and buy that house, pay off those student loans, or finally take a vacation? Can the founders and venture capitalists who funded the company in its infancy finally cash in on their billion-dollar bet? The answer is a hard no, and the reason why is one of the most important and least understood rules of the IPO game. It's called the lockup period, and it is a mandatory waiting game, a set of golden handcuffs slapped on every single insider. From the CEO in the corner office to the venture capital firm that wrote the first check on a napkin. The moment the company goes public, a countdown clock starts ticking. For a set period of time, usually between 90 and 180 days, they are legally forbidden from selling even one of their pre-IPO shares. Their paper fortune is very real, but it's trapped behind a velvet rope, tantalizingly close but untouchable. Why? Why would the system do this? Seems almost cruel. The reason is one of the most brilliant and necessary pieces of market architecture ever designed. It all comes down to one word: confidence. Imagine a brand new magnificent cruise ship is about to set sail on its maiden voyage. The passengers, that's the public, people like you and me, are all buying tickets, excited about the journey. But just as the ship pulls away from the dock, they look up and see the captain, the chief engineer, and the entire senior crew all jumping into the first lifeboat and rowing for shore as fast as they can. What would you think? You'd think the ship is sinking. You would panic. You'd try to get off immediately. That's exactly what would happen to a stock if all the insiders cashed out on day one. It would be a catastrophic signal to the market. It would scream, "We, the people who know this company best, don't believe in its future. We just wanted to get our money and run." The stock price would collapse instantly, wiping out the new public investors and destroying the company's reputation, possibly forever. The lockup period prevents this mass exodus. It forces the insiders to stay on the ship. It tells the public, hey, our fortunes are still tied to this company's success, right alongside yours. We have skin in the game. This alignment of incentives is crucial for building trust in the early, fragile days of a public company. It ensures that the people who built the company are focused on its long-term performance, not just a quick payday. It also creates stability by preventing a sudden, massive supply of shares from flooding the market and overwhelming demand, which would send the price spiraling downwards. So for 3 to 6 months the insiders watch. They watch the stock price rise, they watch it fall. They see their net worth fluctuate by millions, sometimes hundreds of millions of dollars a day. And all they can do is wait for one specific predetermined date on the calendar, the lockup expiration. This date is not a secret. It's written in the IPO prospectus for anyone to find. And for savvy investors, this date is circled in red. It's a day of reckoning. Because when that lockup expires, the floodgates can finally open. Millions of shares previously frozen are now unlocked and eligible to be sold on the open market. This doesn't mean every insider will sell everything they own. Many will hold on for the long term. But some will inevitably sell, either to diversify their wealth, buy a house, or simply realize the gains from years of hard work. And the market knows this. The anticipation of this new supply of shares hitting the market often puts downward pressure on the stock price in the days and weeks leading up to the lockup expiration. It's a classic case of supply and demand. More supply, same demand, price goes down. For an unprepared investor, it can feel like the stock is falling for no reason, when in reality, it's a perfectly predictable event. There is no better case study for the sheer, terrifying power of the lockup period than Facebook. When Facebook went public in May of 2012, it was one of the most hyped IPOs in history. But the stock immediately stumbled. It priced at $38 a share and quickly fell, trading below $20 within a few months. Investors were already terrified. And then they looked at the calendar. Facebook had a staggered lockup expiration. meaning different groups of insiders would be free to sell at different times. The first major expiration was about 90 days after the IPO, in August 2012. On that day, 271 million shares held by early investors were unlocked. The day the lockup expired, Facebook stock plunged over 6% to a new all-time low, closing at just under $20 a share, almost half of its IPO price. But the pain wasn't over. The next lockup expiration was in October, unlocking another 234 million shares. Then came the big one. In mid-November, a colossal 800 million shares held by early employees became eligible for sale. The market was bracing for an apocalypse. In the days leading up to it, the stock was hammered by fear and anticipation. Miraculously, the stock actually rallied on the day, partly because the worst-case scenario was already priced in, and Mark Zuckerberg pledged not to sell his shares for at least a year. But the entire episode, a brutal 6-month trial by fire, showed the world just how much a lockup expiration can rattle even the biggest companies on the planet. For a regular investor, knowing that date is the difference between navigating a known obstacle and hitting a financial landmine. But the insiders aren't the only ones who are forced into silence after an IPO. There's another, equally important waiting game that plays out at the same time, and it's called the quiet period. This rule isn't for the founders or the VCs. It's for the investment banks, the Goldman Sachs, the Morgan Stanleys, the very underwriters who took the company public. Under SEC regulations, for a certain period of time following the IPO, typically 40 days, these banks are forbidden from speaking about the company. They cannot issue any equity research reports, they can't publish earnings estimates, and their star analysts can't go on TV and give their opinion on the stock. Why? The logic is similar to the lockup period. It's about fairness and preventing manipulation. These underwriters have the ultimate inside track. They've spent months living inside the company's financials. They know its strengths and weaknesses better than anyone. If they were allowed to immediately start publishing glowing buy recommendations the day after the IPO, it would give them an unfair advantage to hype the stock they just sold to the public. The quiet period is designed to let the market find its footing organically, based on public information, without the powerful and potentially biased influence of the banks that just got paid millions to execute the deal. So, for the first month or so of a company's life on the stock market, there's an information vacuum. The loudest, most influential voices on Wall Street are silent. This can lead to more uncertainty and volatility. Then, just like the lockup expiration, the end of the quiet period is a major event. On day 41, the floodgates of information open. Suddenly, you might see a dozen different analyst reports hit the market all at once, all from the underwriting banks. They will initiate coverage with a buy, hold, or sell rating and a price target. A wave of positive ratings can send a stock soaring. A surprisingly neutral or negative batch of reports can sink it. It's another critical date that sophisticated investors watch, a second invisible tripwire that can dramatically move a stock's price. So you have two clocks ticking the second a company goes public. The lockup clock, counting down the days until insiders can sell their shares. And the quiet period clock, counting down the days until the big banks can publish their research. Both are designed to create a more stable and fair market, but both culminate in moments of intense volatility and risk. Navigating an IPO isn't just about picking the right company. It's about understanding this hidden timeline of post-IPO life. These are the secret rules, the waiting games that happen behind the curtain. But what about the information you can see? Before any of these clocks even start ticking, the company is forced to publish a single document. A document that can be hundreds of pages long, filled with dense legal and financial jargon. But hidden within it is everything you need to know. The company's entire history, its biggest risks, its darkest secrets, and its greatest opportunities. It is the single most important document in the entire IPO process. It's called the S-1 filing, and learning how to read it is like being handed the treasure map. So let's open it. Let's look at this map. The first thing you'll see is a section called the Prospectus Summary. Think of this as the "You Are Here" sticker on a mall map, combined with a glossy travel brochure of all the best stores. It's designed to be appealing. It's the company's elevator pitch, polished to a mirror shine by lawyers and bankers. It will tell you what the company does, what its mission is, and it will give you some key highlights from its financial performance. It's a great place to start to get the basic lay of the land. But you must remember, this is the company putting its absolute best foot forward. This is their dating profile picture. It's not a lie, but it's not the whole truth. To find that, you have to venture off the main path and into the wilderness. And the first, most important stop in that wilderness is a section that every professional investor flips to immediately. It's a section that most beginners skip, because it looks scary and it's written in dense legalese. It's called risk factors. This is not the fine print. This is the main text. This is the company, under penalty of federal law, being forced to list out every single thing that could possibly go wrong and send their stock price plummeting to zero. This is the Here Be Dragons section of the treasure map. It's where the company confesses its deepest fears. Reading the risk factors section is like getting a therapy session with the company's CEO, and they are not generic. A fast food chain's risks will be about rising beef prices and changing consumer tastes. A software company's risks will be about cyber attacks and failing to keep up with new technology. A biotech company's biggest risk might be that its one and only miracle drug fails its final clinical trial. These are specific, concrete dangers. Let's imagine a hypothetical electric truck company is going public. Their risk factors won't just say, competition is a risk. They'll be forced to say, our competition includes Tesla, Ford, and Rivian, all of whom have more money, more brand recognition, and more manufacturing experience than we do. They could crush us. They'll have to disclose things like, we rely on a single supplier in China for our battery cells. And if that relationship sours or if trade tensions escalate, our entire production line could shut down overnight. They might even have to say, our founder and CEO has never run a public company before, and his past business ventures have ended in bankruptcy. I'm not exaggerating. These are the kinds of bombshells you find buried in the risk factors. This section is your best defense against hype. When everyone is screaming about a revolutionary new company, the risk factors section is the sober, quiet voice in the corner telling you exactly how that revolution might fail. Spend more time here than anywhere else. Read every single one. Okay, you've braved the dragons. You understand the risks. The next critical section you need to find on your map is called the use of proceeds. This is a deceptively simple-sounding section that tells you one crucial thing. Where is all the money you're about to give them actually going? This is the moment of truth. Is the money going to be used to build new factories, hire more engineers, expand into new countries, and conduct more research and development? That's a great sign. It means your money is being invested back into the company to fuel future growth. You are funding the future. Or, is the money going to be used to pay off a mountain of old debt? Or worse, is a huge chunk of it going directly into the pockets of the founders and early investors who are cashing out? This can be a massive red flag. If the people who know the company best, the insiders, are using the IPO as their personal exit ramp to get rich, what does that say about the future they see for the company? It tells you they'd rather have the cash than the stock. You should ask yourself why. You're being invited to a party just as the original hosts are grabbing their coats and sneaking out the back door. So you know the risks and you know where the money is going. Now you need to understand the story of the business itself, as told by the people running it. For that, you turn to a section called Management's Discussion and Analysis, or MD&A. If the financial statements are the raw numbers, the what, the MD&A is the why. This is where the management team gets to explain their performance. They'll tell you why revenue shot up by 200% last year. Maybe they launched a new product or expanded into Europe. They'll also have to explain why their profits went down. Maybe they spent a fortune on marketing to acquire all those new customers. This is the narrative behind the numbers. It's their chance to frame the results. But you have to read it with a critical eye. Watch for corporate jargon and vague language. If they say they are leveraging synergies to optimize core competencies, what they probably mean is, we're firing people to save money. Look for clear, straightforward explanations. Good management is honest about its challenges as well as its successes. The MD&A gives you a feel for the people steering the ship. Are they straight shooters or are they snake oil salesmen? Of course, their story has to be based on facts. And those facts are laid out in the coldest, hardest section of the S1. The financial statements. The balance sheet, the income statement, the statement of cash flows. Now, you do not need to be a certified accountant to get value from this. For a beginner, you're just looking for a few key trends. First, look at the top line, revenue. Is it going up? And is the growth speeding up or slowing down? A company with revenues of 10 million, then 50 million, then 200 million is a rocket ship. A company with revenues of 100 million, then 110 million, then 115 million is a barge. Both are moving forward, but you need to know which one you're buying a ticket for. Second, look at the bottom line, net income or profit. Is there any? For many hot tech IPOs, the answer is a resounding no. And that's not necessarily a deal breaker. Amazon wasn't profitable for years because it was reinvesting every penny it made back into growth. The key question is, do they have a believable path to profitability? Or are their losses getting bigger and bigger every year with no end in sight? Third, look at their cash. How much do they have and how quickly are they burning through it? A company that's burning through cash and will need to raise more money soon is a riskier bet than one with a fortress-like pile of cash in the bank. Finally, after you've looked at the risks, the money, the story, and the numbers, there's one last place to check. It's called principal stockholders. This section is a list of who owns the company. It tells you exactly how many shares the CEO owns, how many the venture capital firms own, and how much of their stock they plan on selling in the IPO. Again, you're looking for a signal of confidence. If the founder is selling 90% of her shares, that's a signal. She's out. If she's only selling 10% to diversify her wealth a little, but is keeping the vast majority of her fortune tied up in the company, that's a very different signal. It tells you her interests are aligned with yours. She needs the stock to go up just like you do. You want to invest alongside people who are still true believers, not people who are just cashing their winning lottery ticket. So now you have the map. You know how to read it. You know how to find the dragons in the risk factors, how to check where the treasure is going with the use of proceeds, how to hear the story from management, and how to count the gold coins in the financial statements. You have all the pieces. You can now analyze a company going public better than 99% of amateur investors. But this leads to the single most difficult question in all of investing. You've read the map, you understand the company, you believe in the story. But how do you know what it's actually worth? How do you avoid paying a king's ransom for a chest full of sand? How do you determine a fair price for a piece of a company that has never been publicly traded before? That is the multi-billion-dollar question. And getting it wrong is the #1 reason most IPO investors lose money, even on great companies. So, how is the price actually decided? This isn't like selling a used car on Craigslist where you just pick a number and hope for the best. This is a high-stakes, high-finance process run by some of the most powerful institutions on Wall Street, the investment banks. Think Goldman Sachs, Morgan Stanley, JP Morgan. These are the underwriters we mentioned earlier. Their job is to act as the bridge between the private company and the public market. And their most critical, most nerve-wracking task is to figure out that magic number, the initial share price. To do this, they embark on something called a roadshow. And it's exactly what it sounds like. The company's top executives, the CEO, the CFO, team up with their bankers and go on a whirlwind multi-city tour. They fly on private jets to New York, Boston, Chicago, San Francisco, even London and Hong Kong. But they're not playing to sold-out arenas. They're pitching in sterile, high-end conference rooms to a very specific, very wealthy audience. Institutional investors. These are the giant players, the mutual funds, pension funds, hedge funds, the firms that manage billions, even trillions of dollars. The goal of the roadshow is twofold. First, it's a sales pitch. The CEO gets up and tells the company's story, painting a picture of explosive future growth. They show the slick presentation, the hockey stick revenue charts, and answer tough questions from rooms full of skeptical analysts who have seen it all before. But the second, and arguably more important, goal is to gather intelligence. As the bankers and executives are pitching the company, they're also asking a crucial question. If we were to sell shares, at what price would you be willing to buy, and how many would you want? This process is called book building. The investment bank is literally building a book of orders, a ledger of who wants in and at what price. They're taking the temperature of the market, trying to gauge the real, tangible demand for this new stock. It's a delicate dance of hype and data. They'll float a preliminary price range, say, "We're thinking somewhere between $20 and $22 a share." Then they listen. If the big funds are all laughing and saying, "No way, we wouldn't touch it for more than 18, the bankers know their price is too high. But if every single fund is screaming, "We'll take 1,000,000 shares at 22. Can we get more?" then they know they might be pricing it too low. Alongside this real-world feedback, the bankers are in their ivory towers running complex financial models. They use a few core methods. One is called comparable company analysis. It's the most straightforward. They look at similar public companies in the same industry and see what they're worth. If you're taking a new electric car company public, you're going to look at Tesla, Rivian, and Lucid and analyze their financials, their revenue, their growth, their profit margins, to get a ballpark idea of what your company should be valued at. Another method is more like financial fortune telling. It's called a discounted cash flow, or DCF analysis. Here, the bankers try to project how much cash the company will generate every year for the next 5, 10, even 20 years. Then they apply a discount rate to that future money, because $1 tomorrow is worth less than $1 today. It's an attempt to calculate the value of all the company's future profits in today's dollars. It's highly technical, full of assumptions, and as much an art as it is a science. After weeks of the roadshow, after countless meetings and thousands of spreadsheet calculations, the bankers and the company executives huddle in a room the night before the IPO. They look at all the data, the financial models, the market conditions, and crucially, the demand they saw in their book of orders. Now they have to solve the Goldilocks problem. They need to find a price that is not too hot, not too cold, but just right. And the stakes for getting this wrong are astronomical. Let's look at what happens when the price is too high. The most infamous example in modern history is Facebook's IPO in 2012. The hype was off the charts. It was the most anticipated tech IPO since Google. The roadshow was a massive success, demand was through the roof. The bankers, led by Morgan Stanley, got greedy. They kept raising the price range, finally settling on $38 per share, at the very top of the range. They also increased the number of shares being sold. They thought they had a runaway success on their hands. They were catastrophically wrong. On IPO day, the stock opened and immediately started to fall. There were technical glitches on the Nasdaq exchange, but the real problem was the price. The initial hype buyers rushed in, but the big, serious institutional money stayed on the sidelines, thinking, this is way too expensive. The stock, priced at $38, closed its first day at just $38.23. And then the bloodbath began. In the following days and weeks, the stock collapsed. Fell below 30, then below 25, then below 20. It lost nearly half its value in just a few months. It was a disaster. Investors who bought in at the IPO price lost their shirts. Lawsuits were filed. Morgan Stanley's reputation took a massive hit. It was the perfect example of what happens when IPO greed and hype lead you to set a price that the market simply won't support. Okay, so pricing too high is a nightmare. The obvious solution is to price it lower, right? Better to be safe than sorry. Not so fast. This brings us to the other side of the Goldilocks problem. Pricing the IPO too low. When this happens, you get something called the IPO pop. This is when a stock priced at, say, $20, opens for trading and immediately rockets up to $30, $40, or even $50 on the first day. For the lucky few retail investors who manage to get shares at the IPO price, this is like winning the lottery. You can double your money in a single day. The media loves it, it creates huge buzz. But for the company that just went public, it's a quiet disaster. Think about it. If you price your shares at $20 and they immediately trade at $40, it means you could have sold those same shares for a much higher price. Every dollar of that pop is a dollar the company left on the table. It's money that went into the pockets of short-term traders instead of into the company's bank account to hire engineers, build factories, and fund growth. If a company sells 50 million shares and leaves $20 per share on the table, that's $1 billion in cash they failed to raise. It's a massive blunder. The founders and early employees just got diluted more than they needed to, and the CFO who led the process probably won't be sleeping well for weeks. So the underwriters are walking this treacherous tightrope. Price it too high, and you get a Facebook-style fiasco that destroys confidence and vaporizes wealth. Price it too low, and you've failed your client by leaving $1 billion on the table. They have to analyze the data, read the tea leaves of the market, and on the night before the launch, place their bet. They have to pick that one single number. That final IPO price is announced to the world, and it sets the stage for one of the most exciting and chaotic events in the financial world. The opening bell on IPO day. An opening bell isn't just a metaphor. It's a real bell, a real ceremony, and the starting gun for a financial sprint. Imagine it. The floor of the New York Stock Exchange, a sea of traders in their blue jackets, a controlled chaos of screens and data. And up on the balcony, beaming, are the founders and early employees of our company. They've been working for years, maybe decades, fueled by coffee and conviction, to get to this single moment. They ring the bell, confetti cannons fire, and the entire world is watching. But here's the secret that most people don't know. When that bell rings at 9:30 a.m. Eastern Time, the company's stock doesn't actually start trading. Not right away. The bell starts the trading day for the whole market, but for our brand new stock, the real action is just beginning behind the scenes. This is where a very important and very powerful figure steps into the spotlight. The designated market maker, or DMM. You can think of the DMM as the master of ceremonies for the stock's debut. They are a highly specialized trader on the floor of the exchange whose job is to facilitate a fair and orderly market for a specific set of stocks. And on IPO day, their job is one of the most high-pressure roles in all of finance. For the next hour, or sometimes even longer, the DMM is at the center of a digital hurricane. Remember all those institutional investors who were allocated shares at the final IPO price? And remember the millions of other investors, from hedge funds to your cousin who uses a trading app, who didn't get an allocation but are desperate to buy. All of their orders are now flooding into the exchange's systems. The DMM screen is lighting up with an avalanche of information. They see buy orders, millions of them. They see the prices people are willing to pay. And their task is to find the perfect opening price. They're not just picking a number out of a hat. They're performing a delicate balancing act called the price discovery process. They have to match the massive number of buy orders with the fixed number of shares being sold in the IPO. It's like being an auctioneer at the world's biggest, fastest, and most high-stakes auction. The DMM, in consultation with the lead underwriter, the investment bank, will start releasing what are called indications. They might send out a message saying, "It looks like the stock might open between $28 and $30. This isn't the final price, it's a test." They're gauging the reaction. If a flood of new buy orders comes in at that range, they know the demand is even hotter than they thought. So they'll revise the indication upwards. Okay, now we're looking at $32 to $34. This process can go on for a while, a back-and-forth dance between the DMM and the market, narrowing down the price range until supply and demand find their equilibrium point. All the while, financial news networks are broadcasting live from the floor, anchors are interviewing the CEO, and traders around the world are glued to their screens, waiting for that first trade. Finally, the moment arrives. The DMM has found the price. The price where the maximum number of shares can change hands in a single massive transaction known as the opening cross. They execute the trade. And for the very first time, the company's stock trades on the open market. Let's say the IPO price was set at $20. But after this intense price discovery process, that first trade happens at $27. This is the famous IPO pop. It's that instantaneous, often massive jump in price from the official IPO price to the price of the first trade on the open market. In our example, that's a 35% pop. The institutions that got in at $20 are immediately up 35% on their investment. It's a moment of pure euphoria for them. But it begs a really important question. If the stock was so clearly worth $27, why did the company sell it for $20? Didn't they just leave $7 per share on the table? Millions, maybe hundreds of millions of dollars, that could have gone into their bank account to fund research or expansion. And the answer is yes, they did. This is one of the most controversial and debated aspects of the entire IPO process. So why does it happen? There are a few key reasons. First, the underwriters want a successful debut. A big first-day pop is a fantastic headline. It creates buzz, it makes the investors who got an allocation feel like geniuses, and it makes the investment bank look good for its next IPO client. It's a powerful marketing tool. A flat or even worse, a broken IPO, one that trades below its issue price, is considered a failure. So they intentionally price the IPO at a discount to the expected market price to help ensure that pop happens. It's like leaving a little bit of juice in the orange for the next person. Second, it's about rewarding the big institutional investors. Remember, these are the bank's best clients. They are the ones who committed to buying huge blocks of shares during the roadshow, taking on significant risk before the stock was even public. The IPO pop is their reward for taking that leap of faith. It's the system's way of saying thank you and ensuring these big players show up for the next big deal. And third, it's just incredibly difficult to perfectly price something that has never been priced before. The underwriters are making a highly educated guess. Sometimes the public demand on opening day is just so overwhelming, so driven by hype and FOMO, the fear of missing out, that it blows past even the most optimistic projections. Investors who couldn't get shares in the IPO are now scrambling to buy them on the open market, creating a buying frenzy that pushes the price up dramatically. So what does this mean for you, the average person watching from home? It means that by the time you can actually buy a share of the newly public company, the easy money has likely already been made.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
That 35% pop happened in an instant before your buy order could even be processed. You're now faced with a choice. Do you buy the stock at its new higher price of $27, hoping it will go even higher? Or do you wait, risking that the stock runs away without you? This is where the real danger begins. The first day, and often the first few weeks, of a stock's life are characterized by extreme volatility. The price can swing wildly. It might shoot up to $35 by lunch, only to crash back down to $25 by the end of the day. The initial hype and flurry of trading are driven by emotion and speculation, not necessarily by the company's long-term fundamentals. It's a trader's paradise, but it can be a minefield for the unprepared investor. Buying into the hype of an IPO pop is one of the fastest ways to lose money if you're not careful. You're essentially buying at the peak of excitement, a point from which the price can easily fall as the initial frenzy dies down. And there's another critical factor at play that pours gasoline on this fire of volatility: the lockup period. Because you see, not everyone is allowed to sell their shares on day one. In fact, most of the people who own the company, the founders, the employees, the early venture capitalists, are legally barred from selling for a set period of time. This creates an artificial scarcity of shares and sets the stage for the next major chapter in the IPO story. This lockup period, as it's called, is one of the most critical, yet least understood, phases of an IPO for the average person. It's a contractual handcuff. For a period typically between 90 and 180 days, insiders are legally forbidden from selling a single share. Think about that. The people who know the company best, the founders who bled for it, the engineers who built it, the venture capitalists who funded it when it was just a dream, are all sitting on a mountain of paper wealth, but they can't touch it. Why on earth would they agree to this? It's not about punishing them. It's about protecting the new investors, people like you and me. It's about stability. Imagine if there was no lockup period. The moment the stock hits the New York Stock Exchange, the CEO, the board of directors, and every early employee could instantly dump all their shares, take their millions, and sail off into the sunset. What would that signal to the market? It would be a catastrophic vote of no confidence. It would scream, "We know the real value and we're getting out while the getting's good." The stock price would plummet to zero in a matter of hours. The IPO would be a spectacular failure, and the investment bank's reputations would be in tatters. So the lockup period serves as a vital cooling-off mechanism. It forces the insiders to keep their skin in the game alongside the new public shareholders. It tells the market, hey, we're not just here for a quick payday. We believe in the long-term future of this company, and we're sticking around to see it through. It provides a buffer of stability, preventing an overwhelming supply of shares from flooding the market and crashing the price before the company even has a chance to prove itself. It allows the stock to find its footing, to establish a trading history, and to be judged on its own merits, not on the selling patterns of its earliest believers. But this period of artificial calm doesn't last forever, and the day the lockup expires is a date that every single investor, trader, and analyst circles in bright red on their calendar. This is the next major inflection point. The day the dam breaks. When those handcuffs finally come off, hundreds of millions, sometimes billions of dollars worth of shares are suddenly eligible to be sold on the open market for the very first time. This creates an immense amount of tension and speculation. What will happen? Will the insiders finally cash in their lottery tickets? Or will they continue to hold, signaling their unwavering faith in the company's future? There are two primary schools of thought here, and the reality is often somewhere in between. The bearish argument is simple: supply and demand. You have a massive sudden increase in the number of shares available for sale, the supply. But there's no corresponding surge in new buyers, the demand. Basic economics tells you that when supply overwhelms demand, the price has to fall. Many of these early employees might have their entire net worth tied up in this one stock. They've been waiting for years for this liquidity event. They want to diversify. They want to buy a house, pay for their kids' college, or just finally realize the fruits of their labor. You can't blame them. But a wave of selling, even if it's for perfectly logical personal reasons, can put immense downward pressure on the stock price. Professional traders know this, and short sellers, investors who bet on a stock's price going down, often pile in around the lockup expiration date, hoping to profit from the anticipated dip. However, there's a strong counterargument. The bullish case is that the lockup expiration will be a non-event. Why? Because sophisticated insiders know that a massive coordinated sell-off would be self-defeating. It would crush their own stock's value. Instead, they might hold on, believing the company is still in its early growth stages and the stock will be worth far more in the future. Selling at the first opportunity would be leaving a fortune on the table. Furthermore, executives often use something called a 10b5-1 plan. This is a prearranged trading plan that allows them to sell a predetermined number of shares at a predetermined time in the future. It's all set up in advance, and it shows the market that their selling is not based on some secret, negative information they just learned, but is part of a long-term, orderly plan for financial diversification. When a lockup expiration passes and there isn't a huge sell-off, it can be seen as a very powerful bullish signal, suggesting the smart money is still firmly on board. For you, the investor, this period is a minefield of volatility. The key is to watch who is selling and how much. Is it a mid-level engineer selling 10% of their holdings to buy a car? That's noise. Is it the chief financial officer and the chief technology officer dumping 90% of their shares the second the lockup expires? That is a massive flashing red signal flare. But the lockup period isn't the only post-IPO waiting game. There's another, equally important countdown happening in the background, the quiet period. Mandated by the SEC, the quiet period is typically the first 40 days after the IPO. During this time, the investment banks that acted as underwriters are forbidden from publishing any research, analysis, or price targets on the company's stock. The company's management is also heavily restricted in what they can say publicly. The entire purpose of the quiet period is to prevent hype from unfairly influencing the stock price. The SEC wants the stock to trade based on the detailed, audited, and legally vetted information in the S1 prospectus, not on some glowing off-the-cuff prediction from an analyst whose bank just earned millions of dollars in IPO fees. It's designed to create a level playing field, where all investors are working from the same core set of facts. But just like the lockup expiration, the end of the quiet period is a huge market event. Because on day 41, the floodgates of information open. Suddenly, all those powerful Wall Street banks, the Goldman Sachs, the Morgan Stanleys, the JP Morgans of the world, can release their official comprehensive research reports on the company. They will initiate coverage with a rating, buy, sell, or hold, and they will issue a price target, which is their prediction of where the stock will be in 12 to 18 months. This can be a massive catalyst for the stock. If all the major underwriters come out with glowing buy ratings and high price targets, it can send a wave of institutional and retail buying into the stock, driving the price up. Conversely, if the ratings are lukewarm or in a rare case negative, it can be a major disappointment and cause the stock to fall. Now, you have to take this with a grain of salt. There's an inherent conflict of interest here that savvy investors are always aware of. The same bank that courted the company, that helped it craft its story, and that made a fortune taking it public is now supposed to be providing an objective, unbiased opinion on whether you should buy its stock. It's very rare for an underwriter to initiate coverage on a recent IPO with a sell rating. It would be like a wedding planner telling the guests the marriage is doomed right after the ceremony. Just doesn't happen. Still, the language they use, the nuances in their reports, and the conviction behind their price targets are all dissected by the market and can have a profound impact on the stock's trajectory. So the first 6 months of a company's life on the public market are a gauntlet. It's not just about the opening bell. It's a multi-stage process. First, the initial pop and the chaos of the first few days of trading. Then the long, tense wait of the lockup period, an artificial barrier holding back a potential tidal wave of shares. At the same time, you have the informational vacuum of the quiet period. And then, everything culminates around the 3 to 6 month mark, as the lockup expires and the analyst reports are finally released, testing the company's true strength in the full, unfiltered light of the public market. But this test, this trial by fire in the public markets, raises the ultimate question for anyone watching from the sidelines. How do you get in on the action? How does a regular person, sitting at their kitchen table, move from being a spectator to an actual participant in an initial public offering? For decades, the answer was simple: you didn't. IPOs were the exclusive playground of the ultra-wealthy and the institutionally connected. It was a private club, and the velvet rope was guarded by the big Wall Street banks. To get an allocation of shares at the IPO price, you needed a 7-figure account with a full-service broker at a place like Goldman Sachs or Morgan Stanley, and even then you needed to be a favorite client. It was a system designed to make the rich richer, giving them first dibs on potentially explosive stocks before they ever hit the open market. For everyone else, the only option was to buy shares after they started trading, often at a price significantly inflated by that famous first-day IPO pop. You were buying the insiders' leftovers at a premium. But in the last few years, the walls of that fortress have started to crumble. The internet, as it has with so many things, has acted as a great democratizer. A new wave of brokerage platforms has emerged, built on the idea that investing should be for everyone, not just the pinstripe suits on Wall Street. And they've specifically targeted IPO access as a key battleground. Companies like Robinhood, SoFi, and Webull have fought to get a seat at the table with the underwriters. They've said to the big banks, "Our millions of retail customers represent real demand, and you need to give us a piece of the pie." And it's working. These platforms are now getting allocations for a growing number of IPOs, allowing everyday investors to request shares right alongside the big funds. So, how does it actually work? Let's say you see that a hot tech company, we'll call it Future Corp, is about to go public and you want in. The first step is to have an account with one of these modern brokerages that offers IPO access. Well before the IPO date, Future Corp will appear in a special upcoming IPOs section of the app. This is your window of opportunity. You'll be able to see the preliminary prospectus, that S-1 filing we talked about, and crucially the estimated price range. Let's say it's $20 to $22 a share. You can then submit what's called an indication of interest. This is not a firm order. Think of it more like entering a lottery. You'll say, "I'd like to request 100 shares of Future Corp." By doing this, you're agreeing to buy those shares if they are allocated to you, and if the final IPO price is within that estimated range. Then you wait. Behind the scenes, the underwriters are finalizing the deal. They're gauging demand from giant institutions, and they're also looking at the total demand from retail platforms like yours. The night before the stock is set to begin trading, they set the final IPO price. Maybe the demand was so huge they price it at $24, a little above the initial range. Because the final price is outside the range you agreed to, the app will ask you to confirm if you're still interested at this new higher price. You confirm, and now the real lottery begins. The brokerage gets its block of shares from the underwriter, and now it has to divide them among all the customers who indicated interest. And almost always, especially for a popular IPO, there are far more requests for shares than there are shares available. So the platform runs its allocation process. Maybe you get all 100 shares you requested. Maybe you get 50. Or, most likely for a really hot deal, maybe you get 0. You'll get a notification letting you know the outcome. If you were allocated shares, the money is taken from your account, and congratulations. You are now a pre-market shareholder in Future Corp, owning shares at the official $24 IPO price. The next morning, when the stock officially begins trading on the NASDAQ or the NYSE, you'll see those shares in your portfolio, ready to be sold or held. But here lies one of the most important and counterintuitive secrets of IPO investing. You have to ask yourself, why did I get an allocation? If a deal is white hot, with every major hedge fund and mutual fund clamoring to get as many shares as possible, the underwriters have very little left over to give to the retail platforms. In those cases, your chances of getting shares are slim to none. Conversely, if you request 100 shares and you easily get all 100, it can sometimes be a red flag. It might mean that institutional demand was weak. It might mean the smart money looked at the deal and decided to pass. And if they're not buying, you have to seriously question why you are. The IPOs that are easiest for retail investors to get into are often the ones that are the riskiest, the ones that are less likely to have that big first-day pop, and may even trade down. This brings us to the great debate for anyone who does get an IPO allocation. Do you flip it or do you hold it? Flipping is the strategy of selling your shares on the first day of trading, sometimes within the first few minutes, to try and capture that initial pop. If you got in at $24 and the stock opens for trading at $35, selling immediately locks in a nearly 50% gain in a single day. It's incredibly tempting. The other strategy is to hold, based on the belief that you're not just buying a ticker symbol for a quick trade, but investing in the long-term future of the business. You've done your homework, you believe in the company's vision, and you think that $35 is just the beginning of a journey to $100 or more. There's no right answer, but there is a catch to flipping. The underwriters and the brokerages want long-term investors, not people who are just going to dump the shares for a quick profit. This kind of activity can increase volatility and make the stock look unstable. As a result, some platforms have rules against it. If you sell your IPO shares within the first 30 days, for example, they might label you a flipper and restrict you from participating in future IPOs for a period of time. You have to read the fine print. Now, this whole process is for a traditional IPO, but there are other paths to the public market, like direct listings and SPACs, which have become increasingly popular. In a direct listing like we saw with companies such as Spotify and Slack, the company doesn't hire underwriters to sell a new block of shares. Instead, they simply facilitate the sale of existing shares, owned by early investors and employees, directly on the stock exchange. There's no roadshow, no fundraising, and no set IPO price. The opening price is determined purely by supply and demand on the first day of trading. For a retail investor, this means there's no special pre-market allocation to apply for. You just place a buy order like you would for any other stock, but you have to be prepared for extreme volatility as the market struggles to figure out what the company is actually worth in those first few hours. And then there are SPACs, or special purpose acquisition companies. This is a totally different beast. A SPAC is essentially a publicly traded shell company, a pot of money, that goes through its own IPO with the sole purpose of finding and merging with a private company, thereby taking it public. So you can buy shares in the SPAC on the open market, and you're essentially betting that its management team will find a great private company to acquire. It's a backdoor way to invest in a company before it becomes a household name, but it carries its own unique risks. Namely, you don't know what company you'll ultimately end up owning. So the door to IPO investing has been cracked open for everyone. Access is no longer the primary barrier, but this access brings with it a whole new set of questions. It's not enough to know how to buy into an IPO. The real challenge, the billion-dollar question, is knowing which ones to buy and which ones to avoid like the plague. How do you dig into that S-1 filing and separate a future market leader from a company built on hype and hope?
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.